Hi guys, thank you for the wait. So we will be starting our webinar soon. Tonight we'll be having our investment analyst Samuel Siew with us. His main area of expertise is in financials, focusing on equity indices and forex. So later he will be discussing several events and how they will impact the US market, and also we will spot potential opportunities that investors can look at for equity indices. So he will be answering to your questions at the end of the webinar. So if you have any questions, do feel free to type them out in the question box. So now I'll pass on the mic to Samuel to talk to you.
All right, thank you, Pei. So tonight I'll be actually speaking to you all about the themes, drivers, and opportunities in US indices. So as we all know, US indices actually is able to influence Asian markets. So I do know that maybe a lot of the audience are actually involved in trading Asian markets, but because US usually sets the direction for Asian markets, we have to look at US markets as well. So before I begin the seminar, just a little disclaimer. So anything that I'll be saying tonight is solely for education purpose only and does not constitute to any form of financial advice. So before you do any investment decisions, please seek proper advice from your financial consultants or respective dealers. So a little bit about myself. All right, I'm an investment analyst with Phillip Futures Singapore. So I specialize at equity indices and forex. So on a day-to-day basis, we do have daily reports on indices and forex, as well as crude oil and other commodities, of which the indices and forex portion is covered by myself. I'm also a market commentator, so you may have seen me on TV before, heard me on the radio, or seen some of my commentaries on the newspaper. I also do conduct events and seminars. So some of the major events that I've conducted before include the Invest Fair last year itself, as well as the recent 联合早报 Forum. For today's seminar as a whole, we'll be going in this order. We'll first start off with US equity indices futures. So I'll introduce to you all what are some of the US equities indices futures you can look at, the key drivers of this of the US market, as well as a 2017 recap of US markets, the factors which impacted the US in the first quarter this year, as well as the view and forecast for second quarter this year itself. So as we all know, the US indices futures actually, there are three major US indices. Okay, there are three major US indices, namely the Dow Jones, the S&P, and the NASDAQ itself. So these are usually the three major indices that people are able to trade either on the futures market. They are able to buy and sell these indices. So just to differentiate what are the main differences between these three index, we will move on to the Dow. So the Dow is actually the most commonly traded, and it's actually price weighted based on 30 blue chip stocks. So this is the components of the Dow itself, whereby we can see that it's relatively well diversified, but it has a key focus on the industrial side of things, as well as the financial side of things as well. So for like example, if there is a major shift in oil prices, we'll see that it will affect the offshore and marine sector, etc. And it is more likely to impact the Dow than the other indices. Also, like example, if we see last night itself, whereby because of easing trade tensions between US and China, we can manufacturing sectors is impacted drastically as well. And because of that, you can see that the Dow moving much more than the other indices itself. So these are some of the weightage that we can see that the Dow comprises of. We can see that the top is actually being Boeing. So Boeing, as we all know, it's an aircraft company, and it's relatively involved in trade deals when there were trade negotiations between US and China. And that's why anything that happens related to that issue, you can see that Boeing share price move a lot, and in tandem, the Dow is the more impacted index as well. And you can see based on the 30 component stocks, it's all mainly blue chip stocks and relatively well diversified. So you can see that earnings seasons and everything like that, when all of these companies are actually reporting their earnings, the Dow is impacted by them as well. For the S&P similar to the Dow, but however, the S&P itself comprises of 500 stocks, and you can see that based on the components itself, it's more diversified. There's a higher weightage on the technology sector, and there's financial sector as well. And you can see that unlike the Dow that has more industrial, this is more well diversified throughout the sectors, and is a more fair representation of the US index as a whole. So people who actually want to track the US index and not have a particular weight on any particular sector, they can consider using the S&P instead. So as you can see, the S&P, based on the top holdings, you can see that quite a number of it is technological stocks, but of which you can see that the weightage is not is well diversified. There's no particular huge weightage on a particular stock itself. And for the NASDAQ, as we all know, is mainly focused on the technology sector. So we can see that the NASDAQ 100, actually, of which 61.26% is tracking the technology sector. So when when President Trump is focused on technology sector, or when you can see that last year when there was a technology sector boom, the NASDAQ actually moved much more than the other two other indices of the US. So if you take a look at the holdings, you can see that the FANG stocks actually comprise of a large amount. So like you can see Apple having 11.83% and Amazon having 10.3%, 10.03%. So if you are actually you are monitoring the US tech sector and you think if the US tech sector has more room for growth and everything like that, you may like to monitor the NASDAQ index instead. So we can see that for the three index, though all of them are tracking US market, there are actually different weightage for each of them, different focus as well. And because of that, investors can use this as a tool to differentiate and use it as a mechanism and a tool to actually hedge the US market or to invest in the US market without looking at individual stocks. So one of the ways is via futures. So we can see that for the S&P itself, it's a balanced index. It's made out of 500 large cap stocks, and it's more sensitive to things like tax cuts and energy deregulations that affect the whole market. Whereas you can see for the Dow Jones, because it's more focused on the industrial side of things, so you can see infrastructure spending, defense spending, etc., will weigh on the Dow Jones index more. And for the NASDAQ, it's very focused on the technology sector. So because of that, it's more sensitive to immigration control, whereby the tech sector is very focused on that because of their workforce. And so last year, when there was immigration control worries in play, you can see that the NASDAQ actually suffering a bit more. But when there was the tech boom due to new technology and everything like that, the tech sector benefited as well. So protectionism policies also affect the NASDAQ as well. And what are the key drivers for US indices? Namely, these 5 points. So we can see that interest rates actually move the index. So why is that so? Because we must understand that when companies or investors actually invest, they are actually looking at two main methods for investing. One is either they look at equities, or second is they look at bonds. So if the bond rates and interest rates actually go too high, it becomes a premium to invest in equities, and of which investors would tend to look at bonds more. And with a reduced interest in equities, you can see a sell down in equities. So usually interest rate and equities have actually inverse relations, and investors usually look at it very closely. Monetary policies by the central bank actually also affect the day-to-day policies of the interest rate. And if the central bank itself is very hawkish, and if, like example, they raise interest rates, it's not going to be very beneficial for US indices. So some of the ways that monetary policy can work is like around 11 years back, when we had the Lehman Brothers crisis, we can see that a lot of markets were down. And in order to salvage the indices and markets itself, monetary policies in terms of quantitative easing was actually introduced to markets. So what it means is actually the US government actually prints money to actually support their economy and everything, giving strength for the economy, and lower down the interest rate so that people are more likely to invest than actually save. And because of that, you can see it actually causing a recovery in stock market. So monetary policies are important in moving indices as a whole. For economic data, is because it will show the condition, the economic condition of the particular country. So because of that, people are actually, when they are looking at indices, aside from corporate earnings, what people are looking at is the particular economic data, because it will actually show if the economy is on track. And if it's on track, it's actually going to give a strength for indices as well, including US index. So what happens is that, like, if like the recent non-farm payroll, or no, the recent inflation rate, for example, it's because of the fact that it sort of like fell below expectations. So people were saying that, oh, because the inflation rate is falling, is slower, what happens is that the Fed is most likely not going to raise rates, and in turn, it actually gave strength to the equities market. That was last week itself. So we can always use economic data as one of the means to actually predict a particular short-term rise or fall in equity indices. And political events, as we all know, is very important. So we can see, like the recent US and China incident, we can see that there were intense relationship recently whereby US and China were on the verge of going to a trade war. So because of this political uncertainty actually weighed on global indices, US, Singapore, China, etc. But because of the tensions actually being relieved yesterday itself, so you can see that US markets actually soared yesterday, and Asian indices soared yesterday as well. And due to a lack of feel good factors today, Asian markets were relatively quiet. For the global environment, is also very important, is because the global environment will actually predict the risk appetite for investors, and it will show whether investors would like to go to safe haven assets or go to more risky assets. So you can see things like last year itself, during the July period, President Kim of North Korea was actually, and President Trump of the US were actually had increased geopolitical tensions. So they were threatening each other on bombing each other, etc. And this resulted in a global fear. And we can see that gold prices, which is a safe haven asset, growing, and equity indices having a sell-off as we see a shift from risky assets to safe haven assets. But nonetheless, this year, with easing environment, we can see that the global tension has sort of like fell, and this actually give more feel good factors for people to invest in equity indices. So these are some of the key drivers that affect US indices, which is the economic data itself. So we can see that the interest rate decisions is very data driven, and so is the equity indices market. So you can see that it's mainly broken down into three main factors. The first being labor. So of which we can assess the labor strength of the US via these three results. The first is the non-farm payroll. Second is the unemployment rate, as well as lastly, the wage growth. So the non-farm payroll is actually released on the first Friday every month, and it's one of the key indicators actually people look to see whether it will give strength to US indices. If, like example, the non-farm payroll is constantly increasing, like we can see in February this year itself. So what happens is that people are worried that due to the fact that the economy is improving, the US has a higher chance, the Fed actually has a higher chance to raise rates, and this in turn causes a sell-off in US indices. And for the inflation, Fed often use inflation as a gauge to see the US economy, and we can see that Fed's target is actually 2%. So they are constantly monitoring, and if, as said during the latest FOMC meeting minutes, is that if, like example, the inflation rate is above their target and constantly remains that way, they have a higher chance of raising rates in the future at a gradual pace. And if you look at the economy actually will give rise to investors' confidence in whether US indices still have strength to continue growth. So we can look at things like GDP, which weigh on the global economic, on the overall economic strength, or the manufacturing and service PMI results. So that as we know, the manufacturing sector is one that President Trump has been constantly focusing at, and we can see that last year itself, he has been, and during his campaign speech, the previous year, he has also been sort of like rallying votes from the manufacturing sector. If constant growth is seen there, it's actually showing that his focus is on track and that there may be more growth for the entire US economy as a whole, as well as retail sales, because of the fact that it actually measures consumer confidence. So if consumers are feeling good about the overall economy, they will tend to spend more and it will generate more retail sales. So we can see that all of these economic numbers actually give rise to an overall picture of the US economy, and it will in turn translate to whether indices perform or underperform. So before we carry on, how do you think the market is now? So some may think it's a bull market, others will see that maybe the bull run has ended and that now it's the start of a bear market. But personally, I feel that it's more of like a kangaroo market, whereby it's very, very volatile, so it's hopping all over the place. So if we take a look at markets last year, we can see that indices had a very good bull run. Throughout the year, it has constantly been increasing. This was in 2017. So if you have bought into the S&P futures, you would have gained approximately 20%. And for the NASDAQ, we all know that last year itself was a technology boom. So companies had a lot of new products. So you can see things like an unexpected iPhone X launch, and then going more into the AR sector, 3D development and everything like that. So it gave rise to a lot of US technology, and in turn caused the NASDAQ to rise faster than the other indices. And for the Dow also grew around 25%, supported by oil prices, which has started to see a bit of recovery. And the main thing is that last year we saw the rise of a new president. So President Trump took over last year itself, and he actually went into the Trump effect. So what is the Trump effect? The Trump effect is actually him being very pro-business as well as pro-US. So we can see that he wanted more business to come back to the US, so he implemented things like tax cuts and everything like that. So it attracted business back to the US. It attracted businesses to, because of cost savings from the tax cuts, actually giving back to the consumers by giving back to the society by actually raising the salary, giving a higher bonuses to its people, to its workers, and the workers in turn spending more, giving rise to higher consumer confidence. So because of all of this, you can see that it's a round cycle effect, and as a whole, it gave rise to the overall economy actually doing better than expected. So even though the rate hike came in December itself, there was a hype giving market confidence along the way. So even as early as March itself, there was a word out there that there will be a tax rate cut happening, and markets are always very forward looking. So because of that, it actually gave strength to market. Also, we can see that last year itself, there was no uncertainty in rate hikes. In 2016, what happens is that the Fed, as well as the markets, actually predicted 3 rate hikes in 2017 itself. And in 2017, that came true. So because of the fact that there was no increased uncertainty in rate hikes, we can see that markets actually did not face a huge sell down. The FANG stocks, which is namely your technology stocks, also outperformed due to new successful product launches, things like your iPhone X, etc. However, what happened this year is that we can see that for the first quarter, markets start going into a sideways trend. So for the S&P futures, it fell approximately 2%. For NASDAQ, even though it rose slightly 1.86%, but in April onwards, due to the Facebook scandal and other technology scandals, it started going down. And for the Dow Jones actually fell 3%. So what is the main thing why markets started to deviate from the bull trend it had last year? Well, this is due to a few factors. Firstly, we saw the start of a new Fed chairman. The way he does things is slightly different from the ex-chairman Yellen. He's slightly more hawkish, and of which it actually gives rise to uncertainty that interest rates may rise more than what Yellen did last year itself. Also, we can see that steel and aluminum tariffs were being implemented, and this caused global fear of trade wars happening. Also, there was escalation escalating trade tensions between China and the US. So just to elaborate a little bit more, in February itself, we saw that there was a start of a new Fed chairman. So it's Jerome Powell. So what happens is that even though he has been in the Fed since 2012, he was very, meaning that he has a lot of experience, but he was more upbeat about the US economy than Yellen itself. And during his first FOMC speech, what happens is that he even though he did not raise the forecast of interest rates rising more than 3 times this year, he actually did something even greater. He raised future forecasts, meaning to say that he's confident that the economy is going to rise faster than expected and that more gradual rate hikes are needed. And so it actually shows his hawkishness. Also, just a little bit to show that how markets are fearful of him, a little side note, which is that on the day he actually became Fed chairman, it was the day that markets fell the most, whereby the Dow fell 1,000 over points. This is because of the fact that before he actually became Fed chairman, during the non-farm payroll result release, it was better than expected, and this gave confidence to market that most likely he's going to be more hawkish than Yellen. And when he came up, market started to react. And he did not disappoint because during the first FOMC meeting, he sounded relatively hawkish as compared to Yellen already. So we are looking towards going forward, the FOMC statements as well as his personal speeches and everything to see if he is going to raise rates faster than expected this year. And if he does, it's going to weigh in on US indices. Also, secondly, we saw that even though President Trump is very pro-US itself, last year, he did not do any drastic things to actually show his protectionism policies. But this year, he started back in March itself, so you can see that he actually stated that he wanted to implement steel and aluminum tariffs. So when we look back at history, steel and aluminum tariffs is actually very hurtful for the economy. This is because back in the 2002, it happened before during the Bush era, which is so happens President Trump's predecessor. President Trump and President Bush are both from the Republican Party, unlike President Obama, who was from the Democrats. So you can see that maybe their policies are a bit similar. So what happens is that if we compare both both policies side by side, we can see that during the Bush era, he was stating that he wanted it for fixed duration from 2002 to 2005, even though it did not last that long at the end of the day. For President Trump, he was stating that he wanted it for a very, very long time. And whereas for Bush, even he stated that he wanted exemptions. So he's exempted the partners that traded closely with the US, that imported a lot of steel to the US, whereas President Trump wanted to have no exemptions at all, but after which he started creating exemptions. So you can see that maybe that's his way of negotiation. He wanted to go hard first and then slowly loosening his stance after that. And of which you can see that President Bush actually wanted, depending on the amount of exports to the US, his tariff amount is going to weigh accordingly, whereas for Trump itself, it's a fixed 25%. But this change afterwards, which we all know, what happens is that at the end of the day, Trump actually exempted a lot of countries. So if we look at some of the countries that actually export steel to the US, the Canada itself is actually exempted, South Korea is exempted, Mexico is exempted. All of the Mexico and Canada is due to the North American Free Trade Agreement, and you can see Taiwan is exempted. So some of the countries, the known countries that are still impacted, things like Japan and China, which we can see that it's not one of their major trade partners. But even if we look at that, we can see that steel and aluminum tariffs in the past have been very detrimental to economies. This is because of the fact that we must understand that US itself relies a lot on foreign steel. A lot of their industries actually use steel. So if like steel cost becomes more expensive for them, what will happen is that going forward, the companies will have lowered revenue due to higher expenses, and this is going to weigh on the economy. So you can see that in 2002, when Bush actually implemented these tariffs, it actually weighed on US indices and weighed on the US dollar itself. And it was only until he lifted it in mid 2003 that we can see a recovery in both the in US indices. So what does this show? It shows that not only did President Bush did not stick to his original plans, it also shows that he actually acknowledges that it's weighing on the economy and tries to actually cause the economy to recover. So right now, even though we are looking at things like that, we have to see that whether in the long run, President Trump is going to lift the tariffs, or if the tariffs are going to weigh in more on the actual US indices itself. And the next is the very recent escalating tensions between China and the US itself. So as the tensions between China and US didn't happen overnight, what happens is that it started from the start of the year, whereby the US itself actually started getting on on China's nerves. So what happens is that they started with sort of like their duties on stainless steels, then followed by the washing machine and solar cell imports tariffs, after which the dumping duties on cast iron and everything like that. But it was only until then followed by the aluminum and steel tariffs, but it was only until much later, which is end of March, whereby the fact that they proposed a 25% duty on Chinese products did it go on to China's, they sort of like hit China, and China actually retaliated. So how did China retaliate is they actually unveil tariffs to hit on US imports. So the US imports they started is actually things that were very close to President Trump's heart: the farming sector, the agriculture sector. So they were mainly on fresh fruits, pork, wheat, grain, etc. Because this was the regions that actually supported President Trump during his campaign. So they wanted to strike it close to his heart. And so after the revelation of the 25% tax on Chinese products, China announced that they want to implement the 3 billion tax, and not long later they straightaway implemented it, and they stated it's due to the fact that they wanted this was solely for the aluminum and steel tariffs and nothing more. It was not for the 25% duties. So after which President Trump actually tried to retaliate, and the US actually released that they would like to do more propose more tariffs on China's products, and China actually stating that okay, let's do a tit for tat. So they started increasing more tariffs as well and proposing much more. So this actually caused global panic, because the world were worried that even though it was between two major powers, US and China itself, that most likely is going to have a direct impact on both economies. But globally, a lot of countries actually export and import to China and the US itself. So with reduced demand in US or China products, the global economy is going to be impacted. And so it caused global panic. Of course, there's an update to this situation, which I'll move into it later. And so, as a whole, we are, for the next quarter at least, we are still bearish on US indices. This is due to a few factors. The first one is that the tax cut effect, which we saw prominent at the start of the year, is slowly winding down. So we can see that last year itself, markets were very hopeful because the tax cut effects were going to benefit markets a lot. And you can see that for the 2017 fourth quarter earnings, which was reported in January itself, it gave a lot of strength to markets because it did better than expected. Surprisingly, in April, that didn't happen when they released their first quarter 2018 results. Rationale is because markets are forward-looking. They have already tried to factor in all this positive impact in. And so even though markets actually outperform analyst expectations, we can see that market sort of like the investors were not impressed by the gains, and so they did profit taking, and you can see a sell down even though sort of like the earnings were good for certain companies and the equities indices as a whole. Hence, we can see that for for the upcoming quarters, even though earnings may constantly still outperform, but because of high market expectations, maybe the impact from the tax cuts will not be so prominent as last time, and we can see the impact on markets, maybe having a negative impact on markets instead of a positive impact. So because of the fact that this has started to normalize, we see a lack of catalysts actually giving more strength to US markets in the upcoming quarter itself. The second will be the potential risks in US and China relations. So even though we do know that US and China relations have started to ease down, whereby both parties have said that they would not want to go into a trade war, and of which they also stated that they would actually put their current tariffs plans on hold while they come to a discussion. You have to note that even though it gave strength to markets yesterday, nothing concrete has been said so far. They have no concrete plans yet, and it's relatively hard for them to come up with a concrete plan in the near future. All right, this is due to a few rationales. First thing, the US wants China to cut their overall trade deficit. China has expressed that they would like to increase trading from the US, but they would like to import in more technology items, which the US is actually strong in. But the US, due to sensitivity, do not want to sell to China any technology products. So because of that, China is actually limited by the amount of things it can import from the US to reduce their trade deficits. So it's impossible they constantly import Boeing airplanes or aero technology products, or constantly import agricultural products, because there's a limited demand for those kind of products. So until they can come to a consensus and find and structure a proper way to reduce the trade deficits, it's very hard to envision that trade deficits is reduced by a huge amount over the next year or so. And so, if like example, they are not able to come to a consensus, what will happen is that this issue will resurface, and they may start going into sort of like trying to tax each other more, etc. kind of thing. And in fact, the existing tariffs that were put into play were not removed. So you can see that the steel and tax tariffs, steel and aluminum tariffs, etc. are still in effect. So we have to see that going forward, how will these negotiations and what stance will China and US take? And if they are able to come to a consensus and settle this issue with clear, defined regulations, etc. And until that happens, it will still act as a potential risk for markets. So we can see that if, like example, US and China constantly go into war, China still have an ultimate trump card. We have to note that China is the largest holder of US treasuries. So if, like example, China were to sell US treasuries, it will cause a drastic sell-off in US indices as well, because it will cause the treasury yield rates to rise out of control. So you can see that right now, US and China as well as Japan are the two largest holders of US treasuries, and we have to look at the relations between China and US as well as Japan and US itself to see what will happen in the treasury markets. So just a little demonstration of what actually the impact it can cause to markets. Back in 2016, there was a margin crisis in China itself, and they were forced to liquidate their positions of US treasuries. And even though global markets were rising, we can see that the US dollar and US indices were held stagnant. This is because of the fact that treasury yield rates were China was selling US treasuries, and it sort of like the markets lacked the factor to continue soaring, and you can see a period of stagnation. However, if like right now markets are relatively more volatile, and if it's slightly a bit bearish, if treasury yield rates rise, or if China actually dispose some of their treasury bonds, we can see quite a drastic impact on markets. And next, we can see that treasury yield rates are rising, and this will potentially cause a sell-off in US indices as well. You can see that right now, treasury yield rates are at its sort of like recent high. It's above the 3% psychological barrier. In fact, recently it hit around 3.1 before retracing slightly, but it's still above the 3% mark. So what does it mean? It means that markets feel that interest rate may go up, and it acts as a mechanism whereby people are deciding whether to invest in treasury yield or in the equity indices. And if, like example, more investors actually move to treasury yield, what will happen is that equities indices may face a sell-off due to the switch of fund flow. And if you look, treasury indices, treasury notes as well as US indices actually do have some sort of relations. I can see recently that it started to diverge. What happens is that treasury yield rate started rising. This period was during the non-farm payroll period, whereby you can see that people had more faith that they're going to raise rates higher this year. So treasury yield rates start rising. And because of that, you can see a sell-off in US indices. And right now, you can see a divergence as well, whereby when treasury yield rates go up, US indices actually fall. The third point would be that we are actually seeing an increased probability of 4 rate hikes this year. So if you look at this chart itself, the green line actually shows the probability of Fed raising rates 3 times this year, while the red line shows the Fed probability of raising 4 times this year. And you can see that right now, there's a higher chance of the Fed raising rates 4 times than 3 times. And what does it mean? It means that interest rates has a higher chance of rising, and people may weigh their options and may sell off US indices instead. And what's the rationale why this is so? Is because of very good economic data that has been released so far. So if we look at the unemployment rate, it's at the 17-year low at 3.9%. The GDP growth is the second longest growth since the financial crisis itself. It has been constantly growing. And if we can look at the PMI results, which is one of the key indicators of President Trump, or the focus, his key focus area, we can see actually growing for 20 consecutive, expanding for 20 consecutive months. All right, since to the end of 2016, it has been expanding till now. So it shows that the US economy is still strong. Also, we can see that if we look at the Fed's key gauge, which is consumer price index, inflation rate as a whole, their target is actually around 2%. And at present, we are looking at 2.5%. So instead of looking at inflation, which is a CPI, they actually focus, the key indicator for the Fed is actually the PCE, which excludes the food costs and everything like that. So if you look, it's also nearing 2%. And with the recent spike, it has actually raised concerns that the Fed will use this as one of the benchmark to actually raise rates this year. And so this actually caused the increased probability of Fed raising rates 4 times this year itself. And so we have to look at the meetings whereby Fed can raise rates. So if you look that there are actually 10 meetings in a year, of which the more focused one will be the 4 highlighted in yellow. Rationale is because of the fact that after these 4 meetings, there will be a press conference at the end of the meeting itself. So it makes it easier for the Fed chairman to actually tell the public his rationale for raising the rates and to ease market fear. So we can see that rates have already been raised in March itself. The next one is in June. So what people are looking at is actually the June statement as well as the one in September, whether he will raise rates or not. Yellen raised rates in March, June, and December last year. So if this year rates were to be raised in September itself, there's a high probability that rates will be raised 4 times this year. And as we near the September and June FOMC meetings, you can see market tension and market fear being heightened as well. At present, though we are still predicting 3 rate hikes this year, markets will still be consolidating and going forward to see whether in September, around the June period and September period, whether there will be more certainty based on economic numbers for higher rate, for more chances of rate hikes, etc. Also, we can see that President Trump's trade tariff have started to show some backlash. This is taken earlier on the week, whereby Japan is reportedly planning retaliatory tariffs against the US itself. So we all know that the largest holders of US treasuries is China and Japan. So if Japan actually does this kind of measures, it's actually going to hurt the US economy. US and Japan also share very close ties. So by doing so, it actually shakens global confidence. And because of this, we have to see whether there will be more progress on this situation. And if like they really were to do so, we can see maybe a sell in US indices as well. And so our forecast is that, as stated, we are still bearish on US index. So if we look at the mini S&P, you can see it's actually more or less since end of January, it has been more or less range bound. So you can see it like that. And right now it's slightly turning bearish. So we can see more potential downside for the remaining quarter. And for the NASDAQ as well, you can see it started retracing. And then right now, if it turns bearish, we can see that the support will still be the 200 EMA, which acts as a strong support for the US indices. And if any of the US indices actually breaks the 200 EMA, it will signify that maybe the bear trend has really started. And the same for the Dow Jones as well, it's still trading a bit range bound since February itself. And what are the other issues that will impact markets going forward? The first will be the improving global tension, geopolitical tension. So you can see that last year itself, we actually saw high risks from July onwards. But this year in April, you can see that North Korea and South Korea actually said that they would declare it that the war has ended, etc. You can see them holding hands. So actually, you can see that geopolitical tension has sort of eased. If going forward, geopolitical tension, the meeting between US and North Korea and Singapore itself actually goes through, and much more certainty is given to markets, this may actually give strength to global markets as a whole. The second one will actually be increased market volatility. So we can see that market has been more volatile than last year. Last year was very smooth. So if market constantly is more volatile, it's actually going to give investors more fear, and it may cause a little bit of a sell-off. But since markets are more volatile, we are able to use this as a way to tap on market volatility and maybe to use futures to buy and sell index and capture on the opportunities itself. So for the 2018 US outlook, for the US side, we're actually bearish on the index. This is due to headwinds from increased US-China tensions and rising treasury rate yields. Also, there's a lack of new catalysts to actually boost markets. And a lot of the time, you can see a lot of investors having this take profit mentality because markets have already been quite high as well. And also, there's increased probability of having 4 rate hikes, as well as the backlash on trade tariffs that actually all of this will cause a sell-off in markets. However, the other issues to look at will be the improving geopolitical tensions, which will actually help boost markets, as well as increased market volatility, which overall will cause market to feel not that confident and may cause a sell-off. And one way to invest in these 3 index will be futures contracts. So people can consider the most commonly traded futures contracts, which is by CME. So it's the mini Dow, the mini NASDAQ, as well as the mini S&P. So futures are actually derivatives products which derive their assets from the underlying asset, which is your 3 index as a whole. And the contracts, though they do not last forever, you are still able to use it to roll over and actually use this as a short-term way to invest in markets. They are leveraged, meaning to say that you only need a fractional of the amount, and you are able to use a small amount of money to actually invest in the product. Of course, it amplifies both your profit and losses. It also allows bi-directional trading. You're not only able to buy, you're able to sell. So it allows you to both have a bullish and bearish view, and it's good in a volatile market. And so what are the advantage of futures? They are basically broken down into these 3 points. One, it allows you to short sell, which you are not able to do it with equities itself. Two, it is very simple. You don't have to monitor individual stocks. You can just monitor the main economic condition and able to use futures, index futures, to actually buy or sell. And lastly, it allows you to hedge or speculate. So it's bi-directional. You can buy and sell. There is no hard and fast rule. Unlike stocks whereby you only can buy and cannot sell, this one you can do it both directions. So you can profit from a rising and falling market. So for example, this is an hourly chart. So what happens, this is back in February when they released the non-farm payroll results. So for example, if let's say you see a market start dropping, non-farm payroll are good, and you decide to short because you can do so using indices futures, and if you short, what happens is that market fear led it to drop, and so just over the short period of time, you are able to capture this market opportunity and you are able to profit on it. And also it's simple. It excludes the process of you having to look at individual stocks to see which is beneficial, which company benefit from this particular rule, etc. kind of thing. By doing the entire index futures as a whole, you can just look at economic data releases. So like all of these factors actually is going to impact indices, and you can just simply at the snap of a finger just buy or sell the particular index, and it will move in tandem to the economic data releases, and you don't have to focus and fine-tune from a large to small approach to see which stock actually suits your needs. And so, for example, it's like the Dow. This is back in February where the Dow pummeled 1,032 points. So, what equity will you pick? A lot of people are not able to pick a particular equity because the whole market is actually going down. So, if that's the case, you see that as a whole market is dropping, you can just use indices futures and just short, and you can benefit from that. You don't have to directly do a stock pick, etc. kind of thing, because some of the smaller cap stocks actually rise even though the rest are dropping as well. And also, it allows you to hedge, meaning to say if you own equities and if you think it's a falling market, you can short the futures to act as a hedge for you. Or if, like example, you don't own any equities, you can use it to speculate as well. And so if you own Amazon, when President Trump actually stated that he has concerns with Amazon and it actually caused a sell from Amazon, what would you do? A lot of people, if they own Amazon, they say they would sell it. But if, like example, after you sold it, if you look at it, actually prices rebounded, and so they may have opportunity cost because they had to buy at a higher price than what they sell it at. But if that's the case, you can use equities futures as a hedge, and if like Amazon prices are dropping, you can just short the equities index, and once you close the position, you can make the profit. And if Amazon continue to rise after that incident due to a knee-jerk effect, you can see that you actually profit from the whole trade itself. And so these are some of the futures that actually trade US indices. We can see that the mini Dow, mini S&P, and mini Nasdaq are the most commonly traded ones. So if you would like to invest or use it as a form of to actually short the market, etc., you can consider this indices futures itself. With that, we have actually come to the end of the presentation. So if there are any questions, please feel free to type it in the question box, and we will answer every question. Thank you.
Hi everyone. Thank you for staying with us to the end of the seminar. We'll start taking some questions now, but I think a couple of you have started asking during the seminar, during the webinar. Okay, we have a Mr. Peter Lai. Samuel, would you be able to answer Mr. Lai's question on the tax cut impact in Q1 2018? You mentioned that it is not as great as Q4 2017. Mr. Lai would want to know, where do you get the data and how do you measure that the impact is not as great?
Okay, so you can get the data is from the fact that if you look at the stock, you look at the accounting methods of the various companies, as well as you can see if you look at a Bloomberg terminal, etc., you can see the impact on the markets. So if you look at even though for both sides, be it first quarter in 2018 and second quarter 2018, whereby April and January they released their results, most of it beat analyst expectations. If you can, based on what was reported and everything like that, you can see that during the earnings season, the Dow, the S&P in April itself actually declined as compared to in May itself, end of April, early May itself, it will actually decline as compared to January itself, whereby when they release the fourth quarter earnings, it actually improved as well. So because of that, you can see that markets are actually reflecting that even though both times they're actually beating market expectations, markets are thinking that maybe the impact is already actually muted and that they expected much more, because we must know that markets are always forward looking, and when they see the impact in the fourth quarter, even though the tax rate cuts were just implemented not long, the impact was so great that markets actually saw, they actually predicted that this time around the same thing would happen. And because of the fact that the results did not tally, whereby it did not have that much of an increase as compared to the fourth quarter as what they have expected, we can see a sell-off, and that's how we actually see that the impact from the tax cuts is actually slowing down and the effect is more or less muted already going forward.
Okay, thank you, Samuel. Mr. Lai has a couple more questions. Mr. Lai, maybe we will send you the replies via email regarding your other questions. Okay, Mr. Kin Chong. Mr. Kin Chong has been asking about using technical analysis. Samuel, would you be able to give the direction of the Dow Jones Index in the coming 3 months? There's a short-term view.
Okay, so if we look at the Dow itself, you can see that right now, based on technical analysis, the 200 EMA, like stated before, is a very important key indicator that people are looking at. So you can see that these 2 times, even back in March and April, it actually bounced off the 200 EMA support. And every time it comes close to 200 EMA support, you can see that major news agencies like Bloomberg, Reuters, etc. have been constantly reporting, because this is the indicator that a lot of technical analysts are actually looking at. The rationale is it actually signifies the change of a trend. So we can see that markets, this chart was taken end of last week, so you can see that markets have actually recovered slightly, but right now it's hitting the Fibonacci resistance. So if, like example, if it breaks above, of which it did due to the easing tensions, we have to see if it can sustain above these levels, because if we note, it's actually trading range bound from the 38.2% levels to the 61.8% levels, around that range. So if it fails to stay above it for very long, most likely it will come back down and test the 200 EMA or the 38.2% levels itself. So we are looking towards, based on the fundamentals, that there's more downside opportunity than upside. And should that happen, maybe during the next three months, we'll look at the relative resistance. If it fails to break above the resistance, most likely it will come back down and hit the support.
Okay, thanks, Samuel. Maybe we have time to take one more question. We have Mr. Lai again. Mr. Lai is asking about, if China were to threaten US by selling treasury, isn't it possible that Japan will probably buy and stabilize it?
Okay, so you have to look that that's the case. So what happens is that Japan actually, if we go back to the chart and we look at over here, so what happens is that in the months that China sold off, Japan was the one that was supporting. But right now we have to look that Japan and US relations aren't that strong as last time, after the US actually imposed tariffs on Japan itself. So Japan markets, if you look at the Japan news itself, they were very fearful of every time Prime Minister Abe and President Trump meets. Rationale is because of the fact that if President Trump constantly push a bilateral deal between US and Japan, Japan is most likely going to suffer from the deal itself. And so when there was no deal struck at all, Japan markets actually benefited. And right now, Prime Minister Abe is actually facing lower popularity due to his recent scandal, and he would not want to lose more votes due to the fact that of this kind of trade-related deals. And so if he actually harshen his pace against the US or try to hold his stand, we can see that even if China actually sells off, if Japan don't buy, then US treasuries will face a situation whereby there are no buyers or limited buyers buying, and with increase in supply and lack of demand, we can see prices actually falling itself.
Okay, thanks, Samuel. There are one or two other questions, but I think regarding trading platforms, Samuel or one of our colleagues will be in touch with you for a more detailed discussion. Once again, thank you for joining us this evening. We hope that Samuel managed to answer most of your questions and give you a good insight into U.S. equity indices. Thank you and have a good evening. Bye-bye.